Hey traders, welcome back to the channel. It is Thursday, March 19th. Let's get right into it. So the market's just closed recently, and this is now 2 straight down days following the Fed meeting. But here's what matters. We bounced off the lows pretty hard, and that tells its own story. So first, let me give you the numbers. S&P 500 closed down about 0.25% at 6,606. The Nasdaq shed 0.28%, settling in at 22,090. And the Dow lost 203 points, closing in at 46,021. But at the session lows, and this is critical, the Dow was down nearly 500 points. The S&P was down a full percent. We came back from the edge and rallied in the last hour of the day. But whether that's buyers stepping in or just exhausted sellers, the question remains the same. Is this a floor, or is it just a pause on the way lower? Remember when I said I thought the war was going to run a lot longer than the politicians said it would, and that I hope I'm wrong? Unfortunately, I wasn't wrong, and the Iran war just escalated again. Overnight, Iran launched strikes on Qatari and Saudi energy infrastructure, and Brent crude responded, settling at $108.65 a barrel, its highest close since July of 2022. The VIX spiked 13% intraday before pulling back to close just under 25. Fear is definitely elevated. It's not panic quite yet, but it's certainly not calm either. Now, a lot of today's selling is really just yesterday's Fed hangover. Powell stepped to the mic yesterday and delivered 8 words that rattled the market. Not as much progress on inflation as we had hoped. That's it. That's what moved markets. The dot plot kept 1 cut on the table for 2026, unchanged. But when you dig into it, the picture is more divided than the headline suggests. 7 of the 19 FOMC members now project 0 cuts this year, and 1 member is actually penciling in a rate hike. One firm on Wall Street, Macquarie, is already calling for the next Fed move to be a hike, potentially in 2027. That's a wildly different world than the 3 cuts traders were pricing in at the start of this year. The other major story today, Micron. And this is a classic lesson for all of you who trade options like me. Micron posted one of the most staggering earnings beats you'll ever see. EPS came in at $12.20 against expectations of $9.31. Revenue nearly tripled year over year, hitting $23.86 billion. Their Q3 guidance was even more jaw-dropping. $33.5 billion in projected revenue, more than double what Wall Street expected. That is an absolute blowout. And yet, the stock still closed down 5 to 7%. This is something we've seen quite a lot recently. The complete beat on all numbers, and yet the stock still trades lower the next day. Why? CapEx. Micron raised its full-year capital expenditure guidance above $25 billion, well past analyst estimates, and told investors that 2027 spending will be even higher. The market heard massive spending ahead and hit the sell button before the ink dried. This is the CapEx override. The same way we saw guidance override a beat with airlines on Tuesday, today we saw spending plans override the guidance. The beat didn't matter. The bill did. So heading into tomorrow, watch oil. Brent above $108 means fuel costs, food costs, transportation, everything will get pushed higher. That's the Fed's nightmare, really. That's why Powell refused to commit to any cuts. And that's why this market can bounce off the lows all it wants. But until there's clarity on the Strait of Hormuz, every bounce is going to face a wall of sellers. This is why I highly advise you to trade conservatively right now and respect your stop out levels. When your price hits the stop out levels, don't hesitate. Don't wait for a bounce. Just do the conservative, practical thing and